Ladies and gentlemen, it has been drilled into the collective psyche of India's retail investors that if they invest in a disciplined manner through a SIP for a period of, let's say, 4 to 5 years, then that's arguably the most reliable way of achieving good inflation-beating returns, which are believed to be around 11 to 12% per annum. But what if I told you that even after doing a SIP in the NIFTY, not for 1 year, not for 2 years, not for 3 years, but for as long as 7 years, the probability of ending up with low double-digit returns, 11 to 12% per annum, has historically been just about 50%, which is the same as the probability of getting a flip of a coin right. But the good news is, by making few simple tweaks and introducing an element of market timing in your SIP, you can take the probability of ending up with a return of 12% per annum or more at the end of a 5-year SIP in the NIFTY to upwards of 90%. This is exactly what we try to achieve for our clients through our proprietary AlphaSIP strategy. Ladies and gentlemen, hi. SIPs have over the last few years become one of the most popular ways for small retail investors from across India to invest in Indian equity markets. So much so that monthly flows through SIPs alone currently stands at a staggering level of almost 26,500 crores per month. That's as of December 2024. That translates to inflows of more than $3 billion flowing into Indian equity markets every single month from small retail investors from across the country. And inflows through SIPs have reached these staggering levels probably because it has been drilled into the collective psyche of India's retail investors that bank fixed deposits can arguably generate a return of the order of 7 to 8% per annum. But if you need more than that, then the most reliable way of generating at least a low double-digit return, 11 to 12% per annum, is by investing in a disciplined manner through a SIP for a period of, let's say, 4 to 5 years. But is that really a sound assumption? Can SIPs really be considered a reliable way of generating low double-digit returns of, let's say, 11 to 12% per annum with a very, very high probability? And if not, is there a way to fix this problem? Let's examine. The chart that you see on your screen right now depicts the historical performance of a 5-year SIP in the NIFTY since the turn of the century. That's since January 2001. In technical language, this is also referred to as the rolling return of a 5-year SIP in the NIFTY. If that sounds like a lot of jargon, don't worry. I'm going to break it up for you in very, very simple language. What we can see in this chart is that we have had as many as 229 months that have already passed by since the turn of the century. That's since January 2001. And had you started a 5-year SIP in the NIFTY in any of these 229 months, then the return that you would have got at the end of these 5-year SIPs is what I've tried to depict in this chart. And if you're wondering what's the point of doing such a humongous exercise, well, the answer is that only if you do this exercise will you be able to find out what has historically been the best case return of a 5-year SIP in the NIFTY and what has historically been the worst case return of a 5-year SIP in the NIFTY. So let's check that out. The best case return of a 5-year SIP in the NIFTY so far has been 45.43% per annum, and you would have got this return had you done a 5-year SIP in the NIFTY between November 2002 and November 2007. The worst case return of a 5-year SIP in the NIFTY so far has been negative 5.82% per annum, and you would have got this return had you done a 5-year SIP in the NIFTY between April 2015 and April 2020. Ladies and gentlemen, what this chart is essentially telling us is that the outcome of a 5-year SIP in the NIFTY largely depends on only one factor, which is market conditions during the course of your 5-year SIP. If market conditions are favorable, if markets are witnessed to very strong rallies during the course of your 5-year SIP, then of course you will end up with returns as spectacular as 45% per annum at the end of your 5-year SIP, as indeed was the case between November 2002 and November 2007. However, if you are unlucky and market conditions are not favorable during the course of your 5-year SIP, if markets are witness to a large market crash during the course of your 5-year SIP, especially if such a crash comes closer towards the end of your 5-year SIP, then you can also end up with negative returns. This is exactly what happened had you done a SIP in the NIFTY between April 2015 and April 2020, because this 5-year period came to an end in April 2020, which is when we got the onset of the COVID pandemic, which in turn led to a brutal 38% crash in the NIFTY. And this is what makes things really tricky for somebody who is trying to save up for a financial goal through a SIP over the next 5 years. Because there is no way to predict if market conditions are going to be favorable or market conditions are going to be adverse over the next 5 years. And ladies and gentlemen, if you think that what I'm trying to do here is to pick on one extreme outlier case of a 5-year SIP ending in the middle of a pandemic, and that the outcome of a 5-year SIP is usually just fine during normal times, then guess what? Once again, that's not really quite true. Because in reality, the historical probability of ending up with even low double-digit returns, let's say around 12% per annum at the end of a 5-year SIP in the NIFTY, something that most retail investors assume to be a given at the end of a 5-year SIP, the historical probability of even that has been abysmally low. Let me explain. As I mentioned a little while back, we have had 229 months that have passed by since the turn of the century. Out of these 229 months, there have been only 125 months out of 229, in case of which a SIP in the NIFTY over the next 5 years produced a return of 12% per annum or more. 125 out of 229 translates to a probability of only 54.6%. What this essentially means is that the historical probability of ending up with a low double-digit return of 12% per annum or more at the end of a 5-year SIP in the NIFTY has so far been only 54.6%. Why do I say only 54.6%? That's because when you toss a coin and you try to guess whether you're going to end up with heads or tail, the probability that your guess is going to be right, even that is 50%. And this effectively means that the historical probability of ending up with a low double-digit return, 12% per annum or more at the end of a 5-year SIP in the NIFTY, something that most retail investors assume is very, very easily achievable, the probability of that is essentially almost the same as the probability of getting a flip of a coin right. Ladies and gentlemen, for sure, there's a huge gap between what retail investors expect from a 5-year SIP and what a 5-year SIP is actually capable of delivering. And this is the problem that we are trying to solve for our clients. We are not necessarily trying to help our clients achieve extraordinarily high returns of, let's say, 20%, 25%, or 30% per annum. Instead, our focus is to help our clients achieve reasonable returns, let's say around 12% per annum, but with an extraordinarily high probability of 90% plus. So effectively, what we are trying to help our clients achieve is to end up with a return of at least 12% per annum or more at the end of a 5-year SIP, irrespective of how market conditions turn out to be during the course of his 5-year SIP. And our intent is to help our clients achieve this return, even if there's a very large market crash during the course of the 5-year SIP. Because only then can a retail investor rely on a 5-year SIP to achieve a financial goal that is due in the next 5 years. And how do we help our clients achieve this? We help our clients achieve this not by pursuing a timing agnostic investment approach, which is essentially at the heart of a conventional SIP based investment strategy. Instead, we go about pursuing the goal that we have set for ourselves by introducing an element of market timing into our investments during the course of a 5-year SIP. So let's understand how we go about timing the markets based on a rigorous rules-based investment approach. Now, the first parameter, which is part of our market timing logic, is something called the PE ratio, which stands for the price to earnings ratio. Now, I have already done a dedicated video explaining what is the PE ratio, how it is calculated, and how you can determine whether a stock is overvalued or undervalued based on its PE ratio. I had published this video on 3rd of August 2024, and you can find a link to this video in the description. Now, the only thing from this video that I want to reiterate once again at this stage is that every stock has a PE ratio. And as the name suggests, it's a ratio which has a numerator P, which stands for the price of the stock, and a denominator E, which is derived from earnings or profit generated by the company over the last 12 months. Now, one more thing that you have to keep in mind about the PE ratio of a stock is that the numerator P, which represents the price of the stock, this is not a static number. The price of a stock changes every day. Therefore, the P ratio of the stock also changes every day. Now let's come to the NIFTY-50 index, which consists of the stocks of the 50 largest companies of our country. On any given day, each of these 50 stocks have their own PE ratios based on their prevailing prices. And if you take an average of the PE ratio of each of these 50 stocks on any given day, what you essentially get is the PE ratio of the NIFTY-50 index on that day. And since the PE ratio of the 50 stocks that are part of the NIFTY-50 index change every day, the P ratio of the NIFTY-50 index also changes every day. The red line that you see on your screen right now represents how the Nifty's PE ratio has moved over the last 25 years. As you can also see on your screen right now, the long-term average of the Nifty's PE ratio during this time has been about 20.01. On the higher side, the Nifty's P ratio has gone to levels of little over 28. On the lower side, the Nifty's P ratio has dropped to about 12.3 in 2001, to an all-time low of 10.68 in 2008, and to a low of about 17 in 2020. Now, how does the P ratio help us predict the future direction of the Nifty? Well, try to understand it this way. Whenever the prevailing P ratio of the Nifty goes significantly above its long-term average, the long-term average P ratio of the Nifty has been 20. Whenever the prevailing P ratio of the Nifty goes significantly higher than 20, those are times when the Nifty is considered to be very overvalued. And the more overvalued the Nifty is, higher is the risk of a large market crash following that. Similarly, whenever the prevailing P ratio of the Nifty drops to levels significantly below its long-term average of 20.01, those are times when the Nifty is considered to be very, very undervalued. And the more undervalued the Nifty is, greater are the chances of a market rally following that. This will become clearer still when we look at the chart of the Nifty's P ratio in conjunction with the chart of the Nifty itself. So let's do that. The blue line that you see on your screen right now represents how the Nifty has moved over the last 25 years. And when you look at these two charts in conjunction, we can clearly see that the risk of a large market correction becomes very, very high whenever the Nifty's P ratio goes significantly higher than its long-term average of 20. In fact, all the large market crashes since the turn of the century have all happened once the P ratio of the Nifty has gone above 28. Let's examine these market crashes one by one. The first time the Nifty's P ratio went above 28 was in February of 2000. And immediately following that, we got a brutal 51% correction in the Nifty over the next 1.5 years. The next time the Nifty's P ratio went above 28 was in January of 2008. And immediately following that, we got a 60% correction in the Nifty over the next 10 months. This correction continues to be the worst in the history of the Nifty. The third time the Nifty's P ratio went above 28 was just before the COVID pandemic. And quite predictably, we got the onset of the COVID pandemic within a very short period of time after that. And alongside that, we got a 38% crash in the Nifty. Similarly, whenever the Nifty's prevailing P ratio drops to levels significantly below its long-term average of 20, those have been the times following which we have seen some of the strongest rallies in the Nifty. For example, the Nifty's P ratio dropped to a low of 12.3 by September of 2001. So clearly the Nifty at this stage was very, very undervalued. And as you can imagine, what followed after that was a very, very strong rally in the Nifty that went on for almost next 7 years. And during this time, the Nifty rallied by more than 7 times. The next time the Nifty's P ratio dropped to the super low levels was in October of 2008, which is when the Nifty's P ratio dropped to an all-time low of 10.68. And this happened in the aftermath of the global financial crisis of 2008, during the course of which the Nifty crashed by as much as 60%. What happened to the Nifty after that? As you can imagine, after that, the Nifty rallied very, very strongly for the next 12 years. And during this time, the Nifty went up by almost 5 times. We got a repeat of the very same trend in the aftermath of the onset of the COVID pandemic. In the aftermath of the onset of the COVID pandemic, we got a 38% crash in the Nifty, and that in turn led to the P ratio of the Nifty dropping from 28 plus to a low of 17.15, which was quite a bit lower than its long-term average of 20.01. And in the aftermath of the Nifty's P ratio dropping to a low of 17.15, we got a furious rally in the Nifty that started on 23rd March 2020. And over the next nearly 4.5 years, the Nifty rallied by almost 3.5 times. Now, based on this, we can of course construct a common sense investment strategy, which is that during times when the Nifty's prevailing P ratio goes to these super high levels of 28 or so, during such times, of course, the Nifty is very, very overvalued. And therefore, during such times, we should consider cutting down the equity exposure in our portfolios to the bare minimum and probably move most of the investment portfolio to a set of debt funds. And vice versa. During times when the Nifty's prevailing P ratio drops to levels significantly below its long-term average, those are times when the Nifty is, of course, very, very undervalued, and we should absolutely consider going to 100% equity allocation in our investment portfolios. Let me be more specific here. What I'm trying to propose here is that on the first trading day of every month, you should rebalance your entire investment portfolio between Nifty and a liquid fund based on the prevailing P ratio of the Nifty as per the rule that I have proposed on the screen right now. Let me explain this rule. What I'm essentially trying to propose here is that on the first trading day of every month, you should first check what is the prevailing P ratio of the Nifty. If you find that currently the P ratio of the Nifty is 28 or more than 28, which of course means that the Nifty is very, very overvalued right now. In that case, as per this rule, I am essentially proposing that for the coming month, you should move your entire investment portfolio to a liquid fund and cut down the equity exposure of the portfolio to zero. If the prevailing P ratio of the Nifty on the first trading day of the month turns out to be between 23 and 28, then for the coming month, you should have only 25% of the portfolio in Nifty and the remaining 75% you should move to a liquid fund. If the prevailing P ratio of the Nifty is between 18 and 23, then for the coming month, you should have 50% of the portfolio in Nifty and the remaining 50% you should move to a liquid fund. If the P is between 15 and 18, then 75% of the portfolio in equity and the remaining 25% in a liquid fund. And finally, if the prevailing P ratio of the Nifty on the first trading day of a month turns out to be 15 or below 15, which of course means that the Nifty is currently very, very undervalued, in that case, for the coming month, you should move the entire investment portfolio to Nifty, which effectively means that you should increase the equity exposure of your portfolio to 100% for the coming month. And for how long should you be doing this rebalancing exercise for? I'm proposing that you should do this rebalancing on the first trading day of every month for a period of 5 years, which is basically 60 months. And when you do the rebalancing of your portfolio as per this rule for a period of 5 years, the historical performance of the strategy has been very, very impressive. This has been the historical performance of a 5-year SIP in the Nifty. We saw this chart earlier in this video. We also saw that so far, the best case outcome of a 5-year SIP in the Nifty has been 45.43% per annum, and the worst case outcome of a 5-year SIP in the Nifty so far has been negative 5.82% per annum. Now let's come to the historical performance of this new strategy that we discussed, in which we introduce this factor of monthly rebalancing between Nifty and a liquid fund based on the prevailing P ratio of the Nifty. So this has been the historical performance of a 5-year SIP in the Nifty, wherein we introduced an element of monthly rebalancing between Nifty and a liquid fund based on the prevailing P ratio of the Nifty. As you can see, based on the new strategy, historically the best case outcome of a 5-year SIP would have been 39.26% per annum, which is slightly less than the historical best case outcome of a conventional 5-year SIP in the Nifty. But look at the worst case outcome. Based on this new logic, the worst case outcome of a 5-year SIP would have been positive 5.4% per annum. In case of a conventional 5-year SIP in the Nifty, the worst case outcome was negative 5.82% per annum. That improves to positive 5.4% per annum when you introduce this new logic. So that's a swing of more than 11 percentage points. What this effectively means is that with this new logic, you get to keep the upside of equity markets during times when the Nifty is witness to very, very strong rallies. And the evidence of that is that the best case outcome of this new logic historically has been as high as 39.26% per annum. But more importantly, even if market conditions were not favorable during the course of your 5-year SIP, even if markets were witness to a large market crash during the course of your 5-year SIP, even then, with this new logic, you could have ended up with a return of positive 5.4% per annum at the end of your 5-year SIP. A return of 5.4% per annum is not very far away from what a bank fixed deposit can generate for you. So effectively, with this new logic, you get to keep the upside if the Nifty delivers during the course of your 5-year SIP. But God forbid, even if the Nifty doesn't deliver during the course of your 5-year SIP, you can potentially end up with returns comparable to that of bank fixed deposits. That's like getting to keep the best of both worlds, isn't it? Now, this obviously makes for a very, very powerful investment strategy. But if you are getting excited about applying this logic to your SIPs, then I must warn you that this strategy has got certain anomalies too, and you must be aware about these anomalies. We saw earlier in this video that all the large market crashes in the Nifty since the turn of the century have all happened after the Nifty's P ratio went above 28. And the most recent instance of this phenomena played out in 2020 around the time of the onset of the COVID pandemic. Just before the onset of the COVID pandemic, the Nifty's P ratio went above 28 for the third time in its history, and quite predictably, following that, we got a 38% crash in the Nifty. But after this crash had played out and the Nifty had managed to bottom at about 7,600 points, after that, a very strong rebound rally kicked in the Nifty from 23rd March 2020 onwards. And as the Nifty started to rebound, the Nifty's P ratio also started to rebound. But this time something really surprising happened. This time round, the Nifty's P ratio did not stop at 28, it did not stop at 30, it did not stop at 35, it did not even stop at 40. This time round, the Nifty's P ratio went all the way up to 42. And what is even more surprising is despite the Nifty's P ratio going all the way up to 42, this time round, we did not get any crash in the Nifty. So why did we get what looks like a breakdown in this long-standing trend of the Nifty invariably crashing whenever the Nifty's P ratio would go above 28? Well, for that, we need to understand the second parameter of our market timing logic, which is liquidity. What exactly is liquidity? Well, liquidity refers to the amount of money that is coming into financial markets. And what is the source of liquidity? Well, the most important source of liquidity for any country is the central bank of that country. In case of India, is the Reserve Bank of India or the RBI, which acts as our central bank. In case of the US, it's the Federal Reserve Bank or the Fed in short, which acts as their central bank. And it is the responsibility of central banks to decide how much money should be printed into existence and released for circulation into the economy. Now, when it comes to liquidity, the central bank that matters the most is the Federal Reserve, because it is the Fed which is responsible for printing into existence the most important currency in the world, which is the US dollar. I call US dollars the most important currency in the world because when the Fed prints new US dollars into existence, the circulation of these newly printed dollars is not limited only within the US financial system. A lot of these newly created dollars also end up in emerging markets, including India, through FII flows. And that's why whenever the Federal Reserve starts printing new dollars at a very, very fast pace, that helps boost liquidity conditions not just within the US financial system, that also helps improve liquidity conditions across emerging markets, including here in India. Let's understand that through a few charts. The chart that you see on your screen right now represents what is called the Fed's balance sheet size. If that sounds like a lot of technical jargon, don't worry, I'm going to break it up for you in very, very simple language. In layman terms, what this chart essentially represents is the amount of new US dollars that the Fed has printed into existence since about 2008. Whenever this red line goes up, that usually means the Fed has printed that many new US dollars into existence. We can also see in this chart that there have been two occasions when the Fed has printed new US dollars at a very, very fast pace. The first time this happened was from late 2008 onwards, and the second time this happened was in the aftermath of the onset of the COVID pandemic in 2020. On both these occasions, we can see that the red line went up at a very, very fast pace, which basically means that during these periods, the Fed was printing new US dollars into existence at a very, very aggressive pace. And whenever the Fed prints money at such a fast pace, the Fed is said to be conducting QE or quantitative easing. And why did the Fed conduct QE from late 2008 onwards and once again after the onset of the COVID pandemic in 2020? That's because the US economy slipped into a very, very severe recession in the aftermath of the global financial crisis of 2008. And in response to that, the Fed started conducting QE in order to provide liquidity support both to the US economy as well as to financial markets. The same thing happened once again in 2020, which is when we got the onset of the COVID pandemic, and as a result, the US economy slipped into a recession once again. And in response to that, the Fed had to once again restart quantitative easing in order to provide liquidity support both to the economy as well as to financial markets. And what is the impact of all this money printing on equity markets, especially equity markets here in India? Well, money printing always ends up being a very, very positive factor for equity markets. And that will become clear when we add the chart of the Nifty here. So let's do that. The blue line that you see on your screen right now represents how the Nifty has moved since 2008. And as you can see, whenever the Fed has conducted QE, that is, whenever the red line has gone up at a very, very fast pace, that in turn has helped improve liquidity conditions. And as a result, the Nifty has rallied very, very strongly on both the occasions when the Fed has conducted QE. In fact, the scale of the money printing that happened in the aftermath of the onset of the COVID pandemic in 2020 was so large that the resulting liquidity support received by equity markets around the world, including here in India, was truly unprecedented. So unprecedented that the Nifty, as we saw a little while back, continued to rally right through 2021, despite the Nifty's P ratio going to an all-time high of 42. Now, this episode has very important lessons for us as investors. The P ratio of the Nifty, which represents valuation, went to an all-time high of 42 in 2021. And under normal circumstances, one would expect the Nifty to correct very, very sharply after that. But it did not. Far from it, the Nifty continued to rally very, very strongly right through 2021, despite the Nifty's P going all the way up to 42. And this happened, as we just saw, because of the liquidity support that the Nifty was receiving as a result of the Fed conducting QE at that point in time. What does this mean? This basically means that liquidity is a far more important factor in determining the future direction of equity markets compared to any other factor, including valuation. And the implication of this is that during times when equity markets are receiving liquidity support as a result of the Federal Reserve printing copious amounts of money, during such times, valuations do not matter. During such times, P ratio of the Nifty can be 42, P ratio of the Nifty can be 142. Markets will not correct. Now, in the light of this, we need to make certain changes in our monthly rebalancing logic. So far, as part of our monthly rebalancing logic, on the first trading day of every month, we would first look at the prevailing P ratio of the Nifty. Instead, what we need to do is on the first trading day of every month, we now need to first look at what the Fed is doing with respect to money printing. If it turns out that the Fed is printing money at a very, very aggressive pace, then well, nothing else matters. We can straight away go to 100% equity in our investment portfolio for that coming month. But how can you conclude if the Fed is printing money at a very fast pace or not? Well, for that, on the first trading day of every month, you need to go and check what is the current size of the Fed's balance sheet size. Then you need to also find out by how much has the Fed's balance sheet size gone up or gone down by over the last 1 year. If it turns out that the Fed's balance sheet size has gone up by 25% or more than 25% over the last 1 year, then that, according to me, is a sufficient condition to conclude that the Fed is printing money and injecting liquidity into the global financial system at a very, very aggressive pace. And if that is the case, then we just saw that nothing else really matters, and therefore we should simply go to 100% equity in our investment portfolio for that month. But if it turns out that the Fed's balance sheet size has gone up over the last 1 year, but by less than 25%, or has not gone up at all, or still worse, has gone down over the last 1 year, in that case, my suggestion is that for that month, we should decide on the equity allocation of the investment portfolio based on the rule linked to the prevailing P ratio of the Nifty. This is the same rule that we discussed earlier in this video. Now let's look at what has been the historical performance of a 5-year SIP based on this revised monthly rebalancing logic linked to two market timing variables, Fed balance sheet size and Nifty's prevailing PV ratio. This was the historical performance of a 5-year SIP when you do monthly rebalancing between Nifty and a liquid fund based on one market timing parameter, which is the prevailing PV ratio of the Nifty. We saw this chart a little while back. We saw that the best case outcome of this strategy so far has been 39.26% per annum, and the worst case outcome of this strategy so far has been positive 5.4% per annum. Now let's examine what's been the historical performance of the revised monthly rebalancing logic that is linked to two market timing variables, which is Fed's balance sheet size and the prevailing PE ratio of the Nifty. The historical performance of the revised two variable logic has been this. As you can see, the best case outcome in this case continues to be 39.26% per annum. But look at the worst case. The worst case in case of the two variable logic is now positive 6.37% per annum. So the worst case outcome improves by another 1 percentage point from 5.4% per annum to 6.37% per annum when you introduce monthly rebalancing based on two variables. Not just that, what is even more remarkable is that the median case outcome improves by almost 4 percentage points from 12.11% per annum to 15.93% per annum when you introduce monthly rebalancing based on the two variable logic. Now, if you're not familiar with what is median and how does it differ from average, then this is something that I've already covered in a previous video of mine, which I had published on 27th August 2024. You can find the link to this video in the description of this video. Just go to this video and watch from 25 minutes 31 seconds for a period of 3 minutes. Now let's go back to the historical performance of the two variable logic. And you'll be surprised to know that the improvements in worst case and median case outcome, impressive as they are not even the most important improvements that you get when you apply the two variable logic. What do I mean by that? Well, for that, I need to take you to this chart. We saw this chart earlier in this video, and this chart depicts the historical performance of a conventional 5-year SIP in the Nifty. In this chart, we saw that since the turn of the century, we have had 229 months that have already passed by. And out of these 229 months, only in case of 125 months has a SIP in the Nifty over the next 5 years produced a return of 12% per annum or more. 125 out of 229 translates to a probability of only 54.6%. Now let's move to the two variable logic. This is the historical performance of a 5-year SIP based on the two variable logic. Now guess Out of these 229 months, in case of how many months a SIP over the next 5 years produced a return of 12% per annum or more? That count goes up to 191. 191 out of 229 months translates to a probability of 83.4%. What this means is that in case of a conventional 5-year SIP in the NIFTY, the historical probability of ending up with a return of 12% per annum or more at the end of a 5-year SIP has been only 54.6%. But when you introduce monthly rebalancing based on the two variable logic, the probability goes up to as high as 83.4%. But if you get down to actually executing this strategy, you will very quickly realize that it is almost impossible to execute this strategy, especially if you're trying to do so using mutual funds. And that is because of two reasons. First is exit load. Second is taxation. Now, if you have been a mutual fund investor, you might be aware that in India, most equity mutual funds impose an exit load of 1% if you redeem or switch out from the fund in less than 1 year's time. And if you're going to use any such fund for executing a strategy where you have to rebalance and switch between funds every single month, then you're going to incur a lot of charges because of exit load. Second, and the even bigger challenge is, of course, taxation. In case of mutual funds, whenever you switch between funds, you accrue capital gains and you have to pay capital gains tax on those gains. And if you switch every month, then most of those gains are likely to be short-term gains. And as you might know, the rate of tax that applies in case of short-term capital gains has gone up quite significantly in recent years. And this is where I want to introduce you to the solution that can help us completely bypass the two challenges of exit load and high rate of taxation because of incidence of lots of short-term capital gains. And the solution that I'm talking about is something called ULIP, which stands for Unit Linked Insurance Plan. ULIP is a very unique investment instrument. However, it imposes an important restriction on investors that does not exist in case of mutual funds. And that restriction is that when you invest in a ULIP plan, this investment is subject to a lock-in of 5 years, which effectively means that you can neither stop your SIPs nor redeem your investments in the first 5 years. Now, a lot of retail investors consider this lock-in to be an impediment, but I truly believe that this lock-in is a big plus because it enforces a discipline on investors to stay invested for a cycle of at least 5 years. And what is even more important is that in lieu of this 5-year lock-in, ULIPs enjoy two key advantages that do not exist in case of mutual funds. Firstly, there are no exit loads when it comes to switching between ULIP funds. In fact, there are many ULIP plans where you can switch between funds unlimited number of times in a year. And the second big advantage, and this is really the big one, especially from the standpoint of our monthly rebalancing strategy, as per current tax laws, there is no incidence of capital gains when you switch between ULIP funds. But that is not to say that ULIPs do not have their fair share of problems. Far from it, ULIPs have many serious problems. In fact, those of you who might have heard about ULIPs might be wondering as to why I am trying to promote a product like ULIP that carries such bad reputation because of rampant mis-selling and egregiously high charges. Because of which, historically, most investors who have invested in ULIPs have invariably ended up with very poor returns. Now, the reason why most ULIP investors have historically ended up with very poor returns is something called allocation charges. Allocation charges is the equivalent of what used to be entry load in case of mutual funds. Now, up until 2009, mutual fund companies used to impose something called entry load. If you invested in a fund that imposed an entry load of, let's say, 1% back in those days, then what would have effectively happened is that for every 100 rupees that you would have invested in this fund, 1 rupee would have been deducted towards entry load and only the remaining 99 rupees would have been actually invested. In case of mutual funds, SEBI imposed a complete ban on entry load in August of 2009. However, in case of the ULIP industry, this practice continues to persist even today. Not just that, the quantum of allocation charges, which is nothing but a form of entry load that ULIP companies impose on investors, is truly egregious. Most ULIP companies impose an allocation charge of anywhere between 6% and 12% on their investors. And then there is GST on top of that. Is there a way to get around these high charges? Well, the solution lies in this new breed of super low-cost ULIPs called zero-allocation charge ULIPs. As the name suggests, these ULIPs do not impose any allocation charges on investors. And the reason you may not have even heard about these zero-allocation charge ULIPs is because the commission that is payable to agents and intermediaries in case of these zero-allocation charge ULIPs is so low that nobody really cares to sell or promote these zero allocation charge ULIPs. But at metacaps.ai, we do. Because the zero allocation charge ULIPs truly open brand new opportunities for us to be able to implement the monthly rebalancing strategy that we discussed earlier in this video a lot more efficiently compared to what is otherwise possible using ETFs or mutual funds or even direct stocks. So let's quickly check out what has been the historical performance of the two variable monthly rebalancing logic that we discussed earlier in this video. Had the execution of the logic been done using these zero allocation charge ULIPs. But before that, in order to set the benchmark, let's quickly recap the historical performance of the two variable logic when applied to the NIFTY. So here you go. This is the historical performance of a 5-year SIP when you do monthly rebalancing between NIFTY and a liquid fund based on two market timing variables, Fed's balance sheet size and the prevailing P ratio of the NIFTY. We saw this chart earlier in this video. Now, most of the ULIP schemes available in the market today, including the ones that I'm going to review as part of this video today, came into existence only after 2010. Therefore, for the sake of like-to-like comparison with the benchmark, we should look at this chart that you see on your screen right now, which represents the historical performance of the two variable logic when applied to the NIFTY. We should look at the data of this chart as well for the period from 2010 onwards. So let's do that. The chart that you see on your screen right now represents the same chart, just that we are looking at the data only for the period from January 2010 onwards. Now let's come to the ULIP schemes. The ULIP schemes that I'm going to review as part of this video are offered by this ULIP company called Bajaj Allianz Life Insurance Company. Now, I'm not trying to endorse Bajaj Allianz. The only reason I have picked the schemes of Bajaj Allianz for the sake of illustration is because their schemes have a reasonably long track record going all the way back to 2010. And the second reason I have picked schemes of this company is because Bajaj Allianz was one of the pioneers, one of the first ULIP companies in the industry to come up with these zero allocation ULIPs. So let's check out how the ULIP schemes of Bajaj Allianz have performed historically. This is the historical performance of a 5-year SIP when you do monthly rebalancing between a top-rated large cap fund offered by Bajaj Allianz and a debt fund offered by Bajaj Allianz based on the two variable logic. Now, the equity fund that I've used as part of this illustration is called Bajaj Allianz Equity Growth Fund 2. It is one of the top large cap funds offered by Bajaj Allianz, and the debt fund that I've used as for this illustration is called Bajaj Allianz Bond Fund. Now, let's go back to the performance of the strategy. As you can see, the best case performance of the two variable logic when applied to the Bajaj Allianz ULIPs so far has been 23.3% per annum. Even the historical worst case improves to 8.63% per annum. At 8.63% per annum, even the worst case performance of the strategy is now distinctly higher than what a bank fixed deposit can generate for you. Also, as you can see, the median case outcome of the strategy was 14.05% per annum when applied to the NIFTY. It improves to 16.06% per annum. That's an improvement of 2 percentage points when the logic is applied to Bajaj Allianz ULIPs. And these improvements are even more remarkable when the strategy is applied to a top-rated mid-cap fund of Bajaj Allianz instead of a large-cap fund. Check it out for yourself. This is the historical performance of the two variable logic when the logic is applied to a top-rated mid-cap fund of Bajaj Allianz called Bajaj Allianz Mid-Cap Accelerator Fund 2. The best case outcome of a 5-year SIP so far has been 27.25% per annum, and the worst case outcome has been 8.68% per annum. At 8.68% per annum, the worst case outcome continues to be higher than what a bank fixed deposit can deliver. But look at the median case outcome. The median case outcome improves even further to 18.81% per annum. Now, this has been the historical performance of a 5-year SIP when you do monthly rebalancing based on two market timing variables, rate of change of the Fed's balance sheet size and prevailing P ratio of the NIFTY. In case of our paying clients, we offer to them a proprietary investment strategy called the AlphaSIP Strategy, where we do monthly rebalancing based on not two variables, but more than 15 market timing variables covering both domestic as well as global macro parameters. So what are these key market timing parameters that are part of the AlphaSIP strategy? Well, I had discussed some of the key global macro parameters that drive the AlphaSIP strategy in this earlier video of mine that I had published on 6th of April 2024. In this video, I had discussed some of the key global macro parameters such as the Fed funds rate, the yield curve, and the reverse repo facility. These are arguably the three most important market timing parameters driving the AlphaSIP strategy. You can find a link to this video in the description of this particular video. And this is the kind of outcome that you get when you apply the AlphaSIP strategy to a top-rated large cap ULIP fund. This is the historical performance of a 5-year SIP when you do monthly rebalancing as per the AlphaSIP strategy between Bajaj Equity Growth Fund 2, which is a top-rated large cap fund offered by Bajaj Allianz, and Bajaj Bond Fund, which is a highly rated debt fund offered by Bajaj Allianz. Look at the best case. The best case outcome of this strategy so far has been 32.16% per annum. But most importantly, look at the worst case outcome. Even in the worst case, this strategy has produced a return of 13.6% per annum at the end of a 5-year SIP. That's the kind of downside protection that this strategy brings to table for you. The results have been even more spectacular when the AlphaSIP strategy has been applied to the mid-cap fund of Bajaj Allianz, which is Bajaj Allianz Mid-Cap Accelerator Fund 2. The best case outcome goes up further to 37.87% per annum. But look at the worst case. The worst case outcome now is 18.55% per annum. Even the median case outcome now stands at a staggering 29.02% per annum. Now let's go back to this chart where we are trying to track what has been the historical probability of ending up with a return of 12% per annum or more at the end of a 5-year SIP by applying various different strategies. Now we just saw that the worst case outcome of the AlphaSIP strategy, when the strategy is applied to a large cap ULIP fund as well as to a mid-cap ULIP fund. In both the cases, the worst case outcome has been more than 12% per annum, which effectively means that once you introduce the AlphaSIP strategy, the historical probability of ending up with a return of 12% per annum or more at the end of a 5-year SIP practically goes up to 100%. Now I have to reiterate with every grain of my existence that even though the historical performance numbers that you see on the screen right now are absolutely spectacular, they are just that. They are the historical performance of the strategy. There's no way one can and should extrapolate this to mean that these historical performance numbers constitute any kind of indication, much less a guarantee that this kind of performance can necessarily be repeated in the future as well. And I'm not saying this as part of a general disclaimer. I truly mean this. We saw in this video itself how since the inception of the Nifty would invariably crash whenever the Nifty's P ratio would go above 28. But we also saw that this long-standing historical trend spectacularly broke down in the post-COVID era, and the Nifty's P ratio went all the way up to 42 in 2021, and yet this time round the Nifty did not witness any significant correction. The bottom line is, when it comes to equity markets, historical trends and historical performance can at best serve as a useful reference. There's no way that one can guarantee that the same performance or same trends can be repeated in the future as well. Now, this has been the historical performance of the AlphaSIP strategy. Now let's examine how much of these returns are likely to accrue to you after taking into account the various charges that are applicable in case of ULIP schemes. Broadly, there are 3 sets of charges. Number 1, allocation charges. Number 2, fund management charges. Number 3, mortality charges. Let's examine them one by one. The first one is allocation charges. Now, if you are going to use zero allocation charge ULIPs, by definition, allocation charges are zero. In case of zero allocation charge ULIPs, this charge is not going to apply. The next one is fund management charges. Now, the historical performance of the ULIP schemes that I showed you earlier in this video is after taking into account fund management charges. So these charges have already been taken into account and they are not going to dent your final returns any further. The last one is mortality charges. Now, every ULIP investment comes with a certain amount of insurance cover, and the premium that you pay for this insurance cover is what are called mortality charges. And how much is the insurance cover that you get when you invest in a ULIP scheme? Well, typically, the insurance cover that comes with the ULIP scheme is 10 times of your annual investment amount. Let's say if you are investing 10,000 rupees per month through a SIP, then your annual investment amount comes to 10,000 into 12, that's 1.2 lakhs. So in this case, the insurance cover that you will get would be 10 times of 1.2 lakhs, that is 12 lakhs. And the premium that is payable for this insurance cover, which is nothing but mortality charges, depends on your age. In this chart, I've tried to approximate the impact of mortality charges on final returns depending on your age. Mind you, this is just an approximation and you should use this just for the purpose of reference. Actual mortality charges vary quite a bit from company to company and even from plan to plan. Now, this is how you should interpret this chart. Let's first take this chart on the left hand side, and on the right hand side, let's put the chart which depicts the historical performance of the AlphaSIP strategy when applied to a large cap ULIP fund. Now, let's say you are 40 years old. So as per this chart, the impact of mortality charges on final returns in case of your age is 0.6% per annum. Now let's go to the historical performance of the AlphaSIP strategy. As per the historical performance chart, the worst case return of this strategy when applied to a large cap ULIP fund so far has been 13.57% per annum. Let's assume you have been exceptionally unlucky and at the end of your 5-year SIP, you ended up with this worst case return of 13.57% per annum. So in this case, the strategy produced a return of 13.57% for you at the end of a 5-year SIP. From this, you need to deduct the impact of mortality charges, which is 0.6% in case of your age. So after deducting the impact of mortality charges, you are going to be left with a net return of about 13% per annum. So this is the final return that will accrue to you after taking into account mortality charges. As you can see, in lieu of a very small impact on final returns, you can fully protect your family from the risk that in case something unfortunate happens to you during the course of the investment journey, the financial goal for which you have been trying to invest for, that remains fully protected. But this is true only up to a certain age. If your age is 50 or more than 50, then the impact of mortality charges can be quite substantial. In such cases, we usually recommend to clients that they should consider having one of their children as the insured person in the policy. So in case of ULIPs, even if you are the investor, somebody else can serve as the insured person. But only somebody from the family can serve as the insured person. And if one of your children serves as the insured person in the policy, then the mortality charges would be deducted as per the age of the child, and therefore automatically mortality charges will come down quite substantially. Now coming to the part you will be most interested in, which is there a way to make all the spectacular returns that we discussed earlier in this video completely tax-free? Well, there is. In case of ULIPs, under section 1010D, all maturity proceeds are completely tax-free as long as the ULIP investment amount is within 2.5 lakh rupees per year. There's one more condition that you have to meet, which is that the insurance cover in the insurance policy has to be at least 10 times of your annual investment amount. Now, this is a unique tax concession that is available only in case of ULIPs. This is not available in case of investments in mutual funds or direct stocks. So it's a complete no-brainer. If you're planning to invest in equity markets, then before you consider any other options such as mutual funds or even direct stocks, you must first invest 2.5 lakh rupees as a lump sum or 20,000 rupees per month through SIPs in these zero allocation charge ULIPs and first fully exhaust your tax-free allowance that is available to you under section 1010D. And well, if you invest in these zero allocation charge ULIPs as per our AlphaSIP strategy, then there is a further upside in returns that we discussed earlier in this video. Ladies and gentlemen, there are a few different variants in which we offer the AlphaSIP strategy to our clients. You can check out the details on our website, metacaps.ai/products. Ladies and gentlemen, this brings me to the end of this video. Many of you have repeatedly asked me as to what is it that we do for our clients at metacaps.ai. This video was my attempt to address this particular question. It's been a long and intense video. I sincerely hope that you liked the insights that I shared during the course of this video. If you did, then please do like and share this video, and please do consider subscribing to my channel. Ladies and gentlemen, thank you very much for taking time to watch this video. Goodbye till we meet again in the next video.